Hello and welcome to our first Cost of Living podcast of the year. And this month, Hannah and I are joined by Jamie Morovich, who has spent over 15 years working with many of our clients in the data science team, but specifically working with our banking and finance clients. And we've asked him to specifically look into some of the economic indicators as we start this year. So firstly, welcome, Jamie. And to give you an opening question then, at the end of last year, we set a pretty stark forecast. It was in one of these podcasts that we think that about £11.6 billion worth might basically hemorrhage from the economy this year as a result of people having to reset their mortgages. So where are we now based on what's changed since then?
Yeah, that's right. 2022, we saw 9 rate rises from the Bank of England as they tried to get rising prices under control, from effectively nothing, 0.1 at the start of the year, up to 3.5% most recently in December. Inflation figures for December are out next week, but November showed inflation at around 10.7%. Now, importantly, that's almost half a percentage point lower than it was in October. So that suggests that already we're starting to see a slowing down of price rises. It goes without saying that prices are still rising rapidly and at a rate we haven't seen for a very long time, certainly not in a generation. And this is what's continuing to put pressure on nearly all UK households. But I think my view, and one that's sort of echoed by some of the economists and the specialists that we talk to, is that things are probably improving quicker than we originally thought. And interest rates might not need to go as high as predicted by some at the start of the crisis, sort of in the middle of last summer. I expect probably over the course of this year there to be probably maybe 2, maybe 3 further rises until we sort of flatten out an interest rate of around 4, maybe 4.5%. So certainly not some of the figures that were being forecast and predicted, talked by some earlier a few months ago.
That's interesting. You just talked about mortgages, and obviously we were talking a lot about mortgages last year, and we did predict that it'd be one of the biggest and most long-term impact of this cost of living crisis and this recession. What are you seeing in the mortgages space this year and last year?
Yeah, so mortgages are probably the obvious place to start, intrinsically linked to the Bank of England's base rates. Towards the end of last year, we saw sort of market rates topping out at about just over 6.5%. They have since fallen back a little bit, which is obviously good news. The market average is now around 5%, but there are deals out there for 2-year fixes around 3.5%. Now, what does that mean? Well, it means that borrowing is more expensive for people buying homes or moving homes. And actually, that's impacting the property market. UK Finance are forecasting, for example, a fall in property transactions this year, 21% down on last year. So immediately we're seeing sort of some of the breaks coming on in the housing market. That's home buying, but what about people that already have a mortgage and maybe just looking to remortgage? Our figures at CACI, we expect there to be around 700,000 households in this situation just in the first half of this year, slightly more than that actually in the latter half. So that's 1.5 million households having to sort of renegotiate their borrowing on their property. UK Finance have published figures as well around remortgaging. Their figures say that remortgaging is up at 8%. A lot of that is the result of some of the sort of the ripple effects from the pandemic, when a lot of people, first-time buyers especially, took advantage of the stamp duty holiday, got themselves 2-year fixes. That was back in 2021. They're now coming to an end now, and that's why we're seeing this uplift now in remortgage activity. And the fact that so many people are having to re-gear their mortgage now, couldn't really come at a worse time. A lot of people used to rates of around 2% are suddenly being asked to, face up and sign up to offers, much closer to 5%.
Just a quick question on that. Are we seeing everyone having to face that increase, or are we also seeing people extending terms?
Yes, you're right. What we are hearing in the market is that some people are extending the term of their borrowing as well, and that will help offset, the increase in monthly payments they're having to face.
Okay, so I guess back to that 11.6 billion number, not only are we seeing the rates dropping slightly, which will lower that, but also potentially some of that will be offset over time, but it does mean the effect will be longer. Okay, so what does all this mean for the so-called average mortgage?
Yeah, so I guess in terms of an average household, I mean, it's difficult to say. It varies obviously depending on circumstances. But if you were previously on a 2% and looking at 5%, then that might be an extra £200 a month that you've got to find. Now, that's going to be significantly more in London or South East. If you've got a detached home that you're remortgaging, for example. So we can see that figure going up considerably for some of those households. Yes, the least affluent homeowners will be hit hardest, those with lowest disposable income. But all of a sudden, I think we're going to see a huge extra burden on the middle income, the double income households, where we'll see groups that normally would be expecting, we describe them as living a comfortable lifestyle, and they're suddenly going to start to need cutting back on their expenditure for 2 years, 5 years as their new mortgage term. In terms of the outlook from the banking industry, the forecasts are a little bit downbeat. They're predicting that 100,000 homeowners are likely to be in mortgage arrears in 2023. So that's behind on their payments at the end of the year. To put that into context, that's about 25% more than last year. And in terms of at the severe, the crisis end of the spectrum, repossessions are predicted to almost double this year. So that's about just over 7,000 people that are possibly at risk of losing their home in 2023.
Thanks, Jamie. That's obviously a really alarming stat to hear. I want to talk a little bit about renters as well, though, because obviously, as we've talked a lot about in this podcast previously, this financial burden doesn't just stop with the mortgage owner. Often that burden is then transferred on to potential renters. I'm just interested to know what's going on in that space.
Yeah, you're absolutely right. Interest rates affect the rental market as well. Landlords will often, if they've got a buy-to-let mortgage, or if they're just facing increased costs themselves at home, their cost of living is going up, then they'll be passing these costs on to tenants. On average, rents are up around 4%. Office of National Statistics say that a quarter of tenants in the UK have seen a rent rise in the last 6 months. So what that actually implies is that for those affected, we've got some very sharp increases in rents that they're having to face and stump up. I think private renters in particular are affected. So that's typically your younger and your more urban demographics. And I know that some of the research that we've done previously have already showed evidence that these are some of the groups that are cutting back on some of their expenditure, their subscriptions, their gym memberships, etc. Social renters also impacted. They're protected a little bit by a cap on rent rises, 7%, but that is still a significant hike for those people as well. I think renters typically spend about a quarter of their outgoings on housing costs. So it's really easy to see quite how much and why these guys are impacted by what's going on at the moment in terms of, interest rate rises.
Yeah, so you've already alluded to it, but what do you think will be the sort of demographic impacts on and specifically around people getting into debt or into financial challenges this year?
So I think there's going to be a lot of focus on renters. These are often the groups of people with lower disposable income, and actually in some work we've recently done, they emerged. They were a common thread really in the precarious group of people. So I'm going to talk a little bit about some work we did with an organisation called Fair for All Finance. They're a not-for-profit organisation. They work closely with credit unions and other lenders in the market to effectively make sure there's fair access to money, to finance, to credit for the whole population. We looked at financially vulnerable customers across the UK. We identified 17.5 million adults, that's about a third of the population, that are either in arrears, at risk of getting into debt, or else have limited or no access to credit. Within this, there was a group that was largely made up of private renters. Been renting a long time, a lot of families in this group, and they were trapped in a longer term debt made up of credit card debt, overdrafts, and perhaps other sources, payday loans and things like that. The relatively high housing cost for these groups means breaking that cycle is incredibly difficult. And that's something we're expecting to see become more of a thing over the next few months. I think it's also worth talking about a second group we identified. It's this group around 4 million people, another group that we described as precarious. Reasonable income, but not really much in the way of sort of a savings buffer that they can call upon, limited disposable income, and nearly all of this group of people have a mortgage. So in terms of interest rate rises, this is a group that we really expect to be hit hard, and that's why we've described them as a precarious group. And the research is already showing that this is a group that not only are their debt levels likely to increase over the last year, but also at the moment they're much more likely to be taking out unsecured loans.
We've talked a lot about borrowing and debt so far. Another, I guess, side of the coin is savings. What have you seen in the savings space over the last 6 months, and what kind of do you expect to happen over the next year or so?
Yeah, Hannah, you're right. So, savings is the other side of the coin. Higher interest rates, for savers, if you're lucky enough to have savings, means that you get a larger return on your money. About half the population in the UK has some savings more than £500. But naturally, any extra interest you're getting in savings doesn't, it becomes less relevant if you also have a mortgage, for example. So the people that are actually benefiting here aren't savers. They're savers that typically own their home outright. They're not having to pay a mortgage or pay rent, and that's typically your older demographic groups. How is this likely to play through? Is this going to play through to extra disposable income, extra money going through the tills? Well, unfortunately, probably not. These older demographics tend to be a bit more prudent and attitudinal. They're the people that are likely to be saving for a rainy day, as it were. So we're unlikely to see any extra sort of expenditure from these groups of people. And quite a big shift we've seen in the savings market is a move from instant access savings through to fixed term savings. So that's effectively people locking their money away, because that's ultimately where the best interest rates are. So again, that's not necessarily readily accessible money to be got at. Another thing we looked at is some of the groups and the demographic groups that have increased their savings holdings. And this one's quite an interesting one. It does tend to be the younger acorn groups in terms of the percentage increase in their savings over the last year. There's a few things going on here. One, the obvious one is actually, they have fewer savings to start with. So actually, in terms of percentage point rise, they're starting from a lower base. But actually, there's a couple of hypotheses here, and largely around that more and more people, especially these younger people, are becoming a bit more savvy or a bit cleverer with what they're doing with their money and wanting their money to work. So, for example, if they've got money sitting in a current account, and a lot of young people have money that they might just leave in a current account, they might want to move that into a savings account. Their interest rates are going up to give them a return. And on the flip side, those people with investment portfolios, people that invest in stock shares on one of the many digital platforms out there. What we're also seeing is people moving money back from investments back into savings because it's a safer and ultimately more comparable return interest rate on the money they're investing.
That's really interesting. And do you think that there's also maybe something in the kind of access to technology that advances that kind of behavior amongst the young compared to the older demographics?
I think so. Certainly in terms of digital engagement, it is the younger ones, and they've probably got the most flexibility and ability to react and do these things. But I mean, some of the biggest digital growth, especially in banking and in savings, is with some of these older demographics, especially the pre-retired and the affluent retired, are really getting on board with mobile banking, savings investment apps. So, it's not just anymore limited just to the younger.
Okay. And given that we're kind of veering around the topic anyway, I wanted to finally ask you about consumer behavior. And we've talked about some really enormous macroeconomic trends that are going to take place over the next year and have been taking place. How do you see some of those big things transferring through into consumer behavior and what we see kind of on our day to day?
Yeah, so we've just talked about consumers changing the way perhaps they're managing their money or they're shifting around savings and things like that. But there's definitely a lot of evidence and a lot of stories out there that sort of tap into this. Well, consumers are becoming a little bit more savvy or changing the way they're shopping, behaving, and interacting with brands to sort of deal with the cost of living. Just this week, Sainsbury's have been in the news. They've said that they're seeing more shoppers in store, which obviously goes against the shift to digital trend. And the reason there being that it's much easier to compare prices, shop for bargains and deals, in store than it is if you're shopping online. And they're another brand that have also talked about more people buying own brand and shopping down. No other supermarkets have said similar things. So consumers are changing the way they shop. In terms of Christmas, Christmas is one of the most expensive times of the year for many. Barclaycard said there's clear evidence that people started stocking up for Christmas back in November earlier than in previous years. So, people are wanting to spread the cost, as it were. UK finance figures on credit cards show that credit card balances are rising, but only really in terms of inflationary rises. But it'll be really interesting to see December's figures when they're released to find out whether people effectively want to defer the payment of Christmas across January and February. The same's true really for buy now, pay later. Through the research that we've been doing, our regular surveys, we've seen an increase in buy now, pay later. And if that has continued and stepped up again over Christmas, that's only going to sort of potentially place extra pressure on finances over the next few months.
Okay, fantastic. That is really interesting stuff, Jamie. So to put you on the spot, we're starting a new year. We came at the end of last year. I think everyone was expecting Christmas to be a bit of a sort of economic disaster. Where are we as we head into the new year? Is it balance, more positive, more negative? What do you think?
I think balance, is the key. There's certainly glimmers of optimism. I'm using the word glimmer and optimism sort of cautiously a little bit here, because ultimately interest rate rises do look like they're starting to do the job that they're meant to. And it does seem that the turning point and things starting to improve will likely manifest later in the year. And ultimately interest rates might not need to go up as high as some people originally thought they might do. However, the flip side is that the cost of borrowing has its implications, and millions of people, and in particular private renters, those with mortgages, and even some groups of people that we might traditionally describe as comfortable, they will see longer term strains on their finances.
Okay, thank you very much. And that concludes our session this month. Next month, we will be looking at some of that Christmas trading data, which will start to have come out by then. So it will be a chance to do a bit of a retrospective on how trading has gone. but also we'll be supporting that with our new brand dimensions data, which actually gives real banking data to understand what has been going through the tills. So we look forward to going through that with you, and see you in a month's time.
Thank you.